indicators look great.
Thank you.
Yeah, I mean, I just looked them over briefly, but I mean, definitely clearly tells the story.
Yeah, I was reading a little bit more about just bonds and correlations and just getting into it, and I realized that the trade that we do, the spread trade, the reason it works, and the rubber band analogy and all that, it works when these correlations break, right? Or at least that's my thinking. That's the conclusion I came to. So I figured, can I plot this somehow? And it seems like this is when these correlations break down, that's when our spreads start moving.
Yeah, it's exactly correct. And so if the shape of the curve is fixed, okay, so if that's fixed, then the trade would be 100%, because whenever the correlations break down, if we know the shape of the curve's not moving, then it's just pure mean reversion. Mm-hmm. What adds risk is that the shape of the curve is constantly in flux. So it's natural for the correlations to break down as the shape of the curve is moving. And so I think that's going to be the final piece, is to try to monitor the individual relationships along with the overall movement.
Okay.
Does that make sense?
So, but the first part, along with the overall movement, so tracking the correlations along with the overall movement, can you explain or give me an example of what you mean by that?
Yeah. So if you think of, just breaking down any section of the curve, if the shape didn't change, then it's just supply and demand, and the spreads really shouldn't move at all, but they do based upon buyers and sellers. But if 10s 30s say was trading at a difference of 1, and that difference was 0.5 because it went flatter, this may show the correlations breaking down from where they were when the 10s 30s was at 1, but the shape is now different. So it's not like we could always just use the same correlation when the shape of the yield curve changes from being flat or steep.
Oh, okay, yes. And to add to that, what you just said, one thing I realized too is that this correlation breaking down tells me nothing about direction. It just tells me there's a correlation breaking down, but I don't know if the spread is gonna move up or if it's gonna move down. I just know it's gonna move, or at least that's the feeling I get regarding how the curve is going to, is it going to steepen? Is it going to flatten? That's where I end up looking at other things to
correct. So when a piece of the curve breaks down, then the trader needs to decide which is correct. Is the one breaking down going to set the new kind of mean or norm, or is the one breaking down the one that's just off?
Okay.
Right? Because if all of a sudden you have the shape of the yield curve and say 30s against UB goes very, very steep, rallies out of control. Now we may think that, okay, that part's getting expensive, so we could sell ZB and buy UB. But if that part of the curve is saying, you know what, the whole yield curve is about to really steepen, well, then the ZB-UB is the one that's correct. And the other ones need to adjust to the back end of the yield curve.
I've been like, so pretty much what's going on right now, what we're seeing right now is what you just described. meaning the ZBUV is rallying, or it's higher than the rest of the curve, because the front end of the curve is getting killed compared to the back end of the curve. Right. So I've been looking at that too, and I'm kind of thinking to myself, could this potentially be that the vast majority of the trade, for the time being, has been in the front end, and meanwhile people are potentially using the back end as a hedge, big trade. I don't know. I don't know what to make of it.
So I wouldn't try to look too deep into it, because I don't think you'll ever get the answer that you're looking for, right? Because who knows, right? You're going to end up coming to some conclusion that it might, you're never really going to be able to prove that. So here is the end of 2017, very, very flat compared to what it was in 2016.
Mm-hmm.
Okay, so when we look for correlations to break down, we need to look, you kind of have to fix the yield curve, because it's not factoring in how the yield curve moves. Because if this was one day's activity, it would look like the front end of the yield curve, 2s, 5s, is the correlation's breaking down because it's so far, it's moved so far.
Okay.
But the indicator is not going to reflect that things have changed. The shape of the yield curve has changed, and we don't want to trade off this steepener line. We need to trade off this flattener line.
Okay. So are you saying this in reference to the indicator that you just had pulled up, the one that I we're just looking at, or are you just saying this more generic? Okay. So I guess, like, I see this, and to me, this doesn't tell me much about the yield curve itself. If you go back to your PowerPoint, what it does show me is in how you always explain the diamonds, like the
Yep.
10-carat diamond against the 5-carat diamond. I'm just looking at that, the correlation between those two at any point in time, whether it's in the green line or the blue line in your screen, but not so much the full curve end to end. Well, I guess in the red line is comparing the front end against the back end, so that could be the full curve.
But using that diamond example, is the correct value of the diamond curve the blue line or the green line? Two totally different. Another really good trade for us is to trade the U.S. yield curve against the German yield curve, which is the Boone-Bobble shots, which are traded on Eurex.
Okay, is that over, like, can Thinkorswim does that have access to those futures?
Yes.
Oh, cool.
Yeah, it's Boone-Bobble shots. They're just as liquid as the U.S. Treasuries, which is unbelievable.
Is this considered Forex?
Nope. No. It's traded on the Eurex. It's not Forex. It's fixed income.
Oh, okay.
Eurex products. And they're same math, everything that we do, you just do it on the European stuff. And it's traded through Eurex, interest rate derivatives.
Wow, you just opened up a whole new can of worms for me.
Look at this. So this, it's unbelievable. So Boone, Bobble, and Shots are going to, and Booksell is getting liquidity. The liquidity is probably still not there. But if we look,
oh, wow.
yeah, and now here, I want to show you the liquidity. Yeah, so far, 620,000 contracts have traded.
What's the notional on one of these? Is it equivalent?
I'm pretty sure it's equivalent. I mean, this is a popular trade, so I'm sure it's equivalent.
Yeah, euro, 100,000 euros or 100,000 CHF.
Yep.
Contract values. Okay.
And this is great podcast fodder, because doing exercises like this where you start learning the yield curve, but you don't stop. You keep going further. So if you have the ability to value the yield curve versus the German yield curve, it's just making it more and more sophisticated. And those are trades that, call them your contemporaries or anybody else competing with you in the trade. Those are factors that they're not using. So that's giving you more and more edge. And so as you keep developing, so you can just keep digging deeper and digging deeper, rather than trying to create something, brand new, you're just really diving into a trade.
That's our edge. At least that's what I found what our edge to be, as you've stated before. Our edge is we don't have to trade, number one, and we have time to research and dig into stuff, and I think that now more than ever, with all the technology and all the tools and all the brokers and how easy it is to trade a future for a normal retail trader, it's amazing how much edge one can possibly build with a team with a community such as the Apex community, and yeah, this is awesome.
It's kind of funny, and it's amazing. Right now, German interest rates are trading like under 1% still.
Oh,
yeah. So the right now the gap between U.S. we're rallying and steepening, they're not steepening yet. Here, there you go, 530s, 530s.
Beautiful.
Isn't that awesome?
Yeah.